Welcome to the Property Profits Real Estate Podcast, the show where real estate investors talk strategy, capital, deals, and growth with your host, Dave Dubeau.
Hey guys and gals, welcome back. Today, zooming in from Los Angeles, California, Zach Winter is a very accomplished real estate entrepreneur in the multifamily space. And Zach and his team, they're part of Prosperity Commercial Real Estate, and they invest primarily in multifamily properties, not necessarily in Los Angeles, but in areas that make a little bit more sense. So, hey, Zach, welcome to the show. Great to have you.
Yeah, great being here. Thank you so much for the invite, Dave. I very much appreciate it.
My pleasure. So let's start with a little snapshot, Zach. What does the portfolio currently kind of look like as of mid-2026?
Sure. So as you mentioned, we're investing in large apartment complexes, multifamily. We are located in Los Angeles, but all of our properties are in other states.
Why would that be?
Why on earth would? So, we're targeting states that don't have rent control, that are business friendly, that have population growth, job growth, net migration in, diverse economies. We like areas that have at least one significant STEM focus to their economy that brings in both white collar and blue collar jobs. So we're primarily in the Midwest and a little bit in the Southeast.
Remind us, what does STEM stand for?
STEM, science, technology, engineering, and mathematics. So, science-based jobs, engineering-based jobs, healthcare jobs. Employers that bring in those types of jobs tend to bring in both white collar and blue collar jobs. So it lends to a diverse economy. And those are sectors of the economy that are expanding as well. So it also lends towards further job growth and population growth.
Okay, that makes a lot of sense. So you talk about large properties. What does your buy box currently kind of look like?
Our buy box is, we're looking for apartment complexes that are at least 100 units, and they could go up to about 400 units.
Okay. And how many communities do you have on the go at this particular time?
So we currently have 4 communities in our portfolio. Mm-hmm. We are very selective, so we only acquire 1 to 2 a year. And we've got, depending on the deal, a 3 to 7 year holding period. So on average, a 5-year hold. So that gives you some idea of why at any given time, we don't have a huge number in our portfolio. We're exiting and entering 1 or 2 deals a year.
So Zach, a lot of people in the multifamily space have taken a bit of a kicking over the last few years. It was the go-go times for a number of years there. It seemed like nobody could do any wrong. Then we found out otherwise. How has that situation affected you guys, if at all?
Well, it has affected us. We have 2 of our 4 properties. We've got 2 properties that I would categorize as workforce housing, and then 2 properties that I would categorize as Class A and Class B+. Okay. The Class A and Class B+ have not been impacted at all. It's the workforce housing where we've seen some increase in delinquency and evictions. And so we've had heightened evictions at those properties. And then we have to obviously replace those non-paying tenants with paying tenants. So I think there has been this bifurcation in the economy. It seems to be if you're doing well, if you have assets and you're able to save and invest in appreciating assets, you're doing fine. But if you don't have assets, you're more likely to be in the category of it's getting a little tight. Inflation is exceeding wage growth. And so that's kind of the bifurcation that we're seeing on the ground.
Yeah, it's challenging times, that's for sure. So I believe that you guys, do you focus still on a bit of a value add play with your properties? What's the...
We do, but our 2 most recent asset acquisitions are the Class B+ and the Class A. And that's really what we're striving for now because of our experience with workforce housing. We're finding that if we can buy newer properties directly from the developer after they've held it for a period of time and it needs a refresh, the units haven't been upgraded, that gets us a couple of things. One is we're getting a better tenant base, and we're not experiencing the eviction rates that we're seeing at Class C properties. But it also gets us newer properties which have much less deferred maintenance issues and unanticipated deferred maintenance issues. So we're primarily gravitating towards newer properties. So we're targeting 1995 or newer properties.
Okay. So you give them a little bit of a refresh. Are you seeing much of a bump in rates in rents for being able to do that, or?
We are. So I'll tell you that the issue that's come with inflation is, for example, 10 years ago, we could renovate an apartment unit for, say, $10,000 to $12,000. Mm-hmm. Now, that same apartment unit, we're looking at, say, $18,000. Mm-hmm. And so if you do an ROI calculation on how many years it will take to get to break even on that $18,000 based off of the rent bump, it's a little more challenging. So we have to be more strategic in what we're spending to upgrade the units to get the anticipated rent bump.
Mm-hmm. I would imagine. Plus, so when you're buying these B plus Class A type properties, what does I imagine you're looking for properties that are pretty much low vacancy, right? You're not looking for properties that have a lot of vacancy there.
Yes.
Or are you?
No, we're looking for stabilized properties. We're very conservative in our approach. So we like to use agency debt. So by nature, it's got to be a very stabilized property. Right. But we're looking for properties where the rents are below market, and where we can come in and implement strategies to increase the rents and other strategies to increase the net operating income. That increases the cash flow that our investors receive while we hold the property. And then it also significantly increases the overall value of the property, since the value is based off of the net operating income times the capitalization rate or cap rate. Yeah. So because we're looking for newer product, it doesn't necessarily mean our value add necessarily includes upgrading the units. So I'll give you an example. We purchased a property in Indiana that was built in 2020. We bought it in 2024. Class A property. It's the best apartment complex in the city. The units were beautiful. They don't need anything. But we bought it from the developer. The developer tenanted it up at below market rents, and they were not charging a lot of the ancillary revenue stream charges that you would typically charge.
Like what?
So they weren't charging a pet fee. They didn't have bulk internet, and they weren't charging an internet fee and making an arbitrage off of that. They weren't charging valet trash. They were undercharging for regular trash. Their RUBS, or residential utility bill back, was at a very low percentage. So once you factor all those in, and then you also streamline the expense side of the equation, that's your value add on a property like that.
And how do you do that without taking off the existing tenants and having them move out? Is it because they're in the nicest property in town, or what keeps them in?
Well, you can't just implement fees on an existing lease, but keep in mind we're not in a rent-controlled area where leases have to renew. We're in one-year leases that are expiring throughout the course of the year. So as those leases come up for renewal, then we'll roll in the fees, okay, and increase the rents up to market rate. And if the tenant doesn't want to pay it, that's fine, because we'll find a replacement tenant.
Got it. Okay. No, that makes a lot of sense.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
Very, very cool. So what is the typical exit strategy for you with these kind of deals, Zach?
Well, we like to 1031 exchange. So when we enter the property, we'll conduct a cost segregation analysis to accelerate the depreciation loss. So our investors will receive very nice cash flow while we hold it. But when they get their K-1 tax return, their paper tax loss is exceeding the cash flow that they've been receiving. So it'll totally offset the cash flow that they're getting. If they have other eligible passive income, they can apply it to offset that other passive income. If they don't, it just rolls forward until they need it. So it could roll all the way forward until we sell the property. And if they don't participate in the 1031 exchange, they can use it to offset their capital gains at exit. But most of our clients, the vast majority, will come along with us in the 1031 exchange. And then we'll start the process all over again in the new property, increase the cash flow, do a new accelerated depreciation, and pass on all of that tax savings to the investors on the next property.
Yeah, that's very, very appealing. Okay. Now I've spoken to a number of multifamily operators over the last couple of months, and some of them are getting pretty excited about opportunities coming down the pipeline. Unfortunately, at the expense of other operators who are going through some pretty hard times, but they're starting to see properties, value-wise, penciling out these days. What do you see on the horizon for you guys, Zach?
So, we did get a great deal on a property that we closed on December 30th last year, and it was a little bit of a seller distress situation. Mm-hmm. But that wasn't the majority of the really distressed properties that we're seeing. For example, the properties that are REO'd and the bank's trying to sell them. Mm-hmm. Those are properties that aren't in our buy box. They tend to be older properties.
Yeah.
That we're just not interested in. Oftentimes they're in locations that don't meet our demographic requirements. Mm. So we aren't seeing opportunity for what we're interested in buying in general as part of that overall distress wave that people have been talking about.
Got it. And a big part of the kind of business that you're in is, number one, analyzing properties, yes, taking a look at opportunities, making offers. The other side of things is raising private capital. And some folks in multifamily have been having a bit more of a tough go at it these days because of the situation macroeconomic wise. What have you guys found when it comes to connecting with new investors, with LPs in today's day and age?
It's a good question. I think we're still comfortably raising capital. We have a lot of repeat investors. And then our current clients frequently will refer friends and family to us. Mm-hmm. And we're constantly, open to additional investors coming in. I will say that 2 deals ago, so several years ago, the raises were being completed a lot quicker. So now it could take a little bit longer to fill out the raise, but it hasn't been a problem to fill out the raise.
That's good. One thing I'm picking up on that I kind of like is you don't call them investors, you don't call them LPs, you're calling them clients. Tell me about that, if you would.
Yeah. Well, they really are our clients. We're really open to close communication with them. We pride ourselves in conducting our firm in a very professional way and having ongoing communication with all of our investor clients.
Nice. So there are a lot of operators out there, a lot of syndicators out there, a lot of private equity companies out there. What do you think kind of sets you guys apart versus some of the other folks in the space?
Well, I think we're very selective. We really set out a niche that works for us. That's kind of a proven strategy. Mm-hmm. And we're not chasing the shiny object, just looking to close more deals.
Yeah.
We're very selective. We invest in all of our own deals, which is both important to me and important to our clients. They want to see that we're putting the proverbial skin in the game, right? Yeah. And so I think our interests are very much aligned.
That makes sense. All right. And as we're kind of wrapping up our conversation here, Zach, right now we're in the middle of 2026. Where do you see you and Prosperity going over the next, let's say, 12 to 24 months, the next year or two?
Well, Opportunity Zone 2.0 is going to come out at the end of this year. They're going to identify the new opportunity zones. So one of the new areas that we are looking at is potentially doing an opportunity zone fund to invest in opportunity zone multifamily opportunities. So that will be an extremely good tax strategy for people that have capital gains that they're looking to defer and then eliminate 10% of right off the top. And the beautiful thing about the opportunity zone is after the holding period, you get a complete 100% step up in basis on that property. And so if you exit it at that point, there's zero capital gains. So it's from a tax standpoint, it's one of the best deals out there. So we're
maybe for folks that aren't super up to speed on what opportunity zones are, kind of give us the Coles Notes version.
Sure. So opportunity zones were created, I don't know, about 7 or 8 years ago. And under the One Big Beautiful Bill Act, it had slowly been sunsetting. And under the One Big Beautiful Bill Act, they created what's called Opportunity Zone 2.0. And basically the premise is they're incentivizing you to invest in certain areas that each state identifies which area it is. And theoretically, they're supposed to be areas that they want to have an infusion of capital in to further develop the community. And so if you develop there, there's tremendous tax benefits for doing so. It doesn't have to be real estate. You could be opening up a business. But real estate is one of the qualifying businesses that qualifies for opportunity zones. And so if you have a huge capital gain from whatever, you could sell stock, you could sell Bitcoin, you could sell real estate, you could sell a business, and you have huge capital gains on that sale, you can take the capital gains tax that you otherwise would have had to pay the government and invest it in an opportunity zone business. It defers paying that capital gains for 5 years under Opportunity Zone 2.0, and you eliminate 10% of the capital gains. So you only have to pay 90%. If you invest in the right business, there could be enough cash flow generated over those 5 years to offset that 90% of the capital gains that would be due. And then you hold the property for 10 years, and theoretically it would be delivering cash flow to you, and it would have the tax advantages that we spoke about for investing in real estate. After that 10 years, you get a 100% step up in basis. So you've accelerated the depreciation and had huge tax write-offs during those 10 years. Right. And then even though your basis is very low because you've accelerated the depreciation at the 10-year mark, you get a 100 step up in basis to the then value of the property. So if you sell it, there's zero capital gains on all the profit on sale.
Wow. Now, does that apply to existing buildings or does it have to be new builds?
It can be existing, but the rules are a little technical as to what's required. But typically you take the improved value of the property and you add at least 100% in additional value to it. So
what are you guys planning on doing with those? Because it sounds like you're not in the development business, you're in the buy existing properties.
Right. So it could be, for example, these loft conversions or office to residential conversions. Those are opportunities where you could add 100% by converting an office or an old factory or some other purpose building into residential. It could be, and we've looked at these types of opportunities where there's, let's say, an existing 100-unit apartment complex, but it's zoned to add another 100 units. So you could build the additional 100 units and satisfy the requirement that way. It could be you find a developer that may be distressed and they haven't completed the construction, and you're able to come in and buy a building that's nearly completed and finish the construction and qualify in that way. So there's several different ways to do this without doing a complete ground up construction project.
Okay. Very, very interesting. Awesome, Zach. Well, hey, this has been fascinating. Thank you very much for sharing with us a little bit about what you guys are up to and what the exciting plans are. If people would like to connect with you, what's the best way for them to do that?
Well, the best way is to go to our website, which is prosperitycre.com.
Very good. Zach Winter, thank you very much for being on the call.
Thank you, Dave. Really appreciate it.
All right, everybody. Thanks for tuning in, and we'll see you on the next one.
Thanks for listening to the Property Profits Podcast. If you'd like to be a guest on the show, apply at daveinterviews.com.